Hey folks, welcome back to the Traders for a Cause podcast. My guest this week is a very good friend of mine. He happens to be the man behind the Value Investor's Edge publication on Seeking Alpha and a maritime shipping expert, Mr. J Mintzmyer. Jay, welcome to the show. How are you?
Hey, thanks, Zach. I'm glad to be on. I'm really excited that you've been doing this podcast, and I'm excited that I made it on. I'm not. It's not even guest number 10 yet. Well, you said guest number 9. That's pretty
Yeah,
cool.
yeah. Single
Thanks.
digits, baby.
Yeah, I'm glad that I made it.
Well, I'm glad to have you. Thank you for doing it. And I guess we'll just kick it off and kind of like get a little background on you and how you got into maritime shipping stocks. So what made you choose value investing in this particular sector? And you picked it as a specialty. You've kind of teed off on it. What was it that attracted you to maritime shipping and what fascinates you about it?
Yeah, no, it's definitely a good question because it's such an obscure part of the market, right? And
Sure.
I started investing right around the global financial crisis back in 2008, and that's what sort of honed me in on value as a segment of the market because I saw what happened when you didn't care about fundamentals. I saw what happened when people only looked at charts and momentum and they didn't care about the underlying earnings and stuff like that. So that got me really interested in like the classical value type approach. Ben Graham, Warren Buffett, those type of approaches. So that was my overall framework. I was in college at the time as well, so I was learning, economics, financial analysis, that sort of thing. But after spending a few years there, I realized that, in large names, like, Microsoft was a value name at the time. It's hard to believe that Microsoft was a value name, but it was. Apple at some points was a value name. But, someone like me who is at the time was a student and kind of blogging and starting my own portfolio, I had no chance of providing any sort of edge in that market. If Apple moved up or Microsoft moved up, I could make money, but it wasn't because of my, J Mintzmyer's gift or anything like that. It was just kind of like, luck or the fundamentals of that company. And
Right.
I'm not saying that I couldn't invest there, I still do, but I didn't, have an edge. And so I found shipping. And another reason I found shipping was because it just had these huge volatile swings. I think folks probably remember a stock called Dry Ships. It was a fun one.
Oh, we remember dry ships.
Everybody remembers Dry Ships. That's it. Whenever you see shipping, I was like, oh, is that like Dry Ships? so absolutely. So that got me into the space, and I started realizing that shipping was an area where if you applied fundamental value analysis and you had like a big picture macro view of what was going on in the world, you could really make a killing in certain markets. You could find out what stocks you should probably avoid. You could find out what stocks had potential. It didn't mean you won all the time and whatnot. You still make a lot of mistakes, but there was an area where I, as an individual, and now as a team, we have a team of 5 now, could actually legitimately year after year after year outperform the market.
Incredible. So you think that maybe shipping as a sector is just often overlooked because it doesn't have the same sexiness that, say tech does or some of these other sectors?
Yeah, well, first of all, most of the companies are really small. There's only a handful of companies that are larger than 1 billion market cap. Most of them are anywhere from about 50 million to about 6, 7, 800 million. So almost no institutions can play in that sandbox. There's hedge funds involved, but they're smaller, boutique, sort of family office type hedge funds. They're not the big Goldman Sachs types. So that right away takes a lot of very smart, it's kind of like playing poker, right? Like that right away takes a lot of very smart whales out of the equation. And so you're left with a market that is a lot more uninformed. There's a lot more information asymmetry. Another really cool thing about shipping is that, well, cool for us because we have access to all the data, is that a lot of the shipping data is not readily available to the public. Right, you have to know where to look. And I'm not saying some of it's still free. Most of it you have to pay for, which we do, but some of it's free, but you have to know where to look. And so, if you just see the headline, Baltic Dry Index at record highs, okay, that's cool, but what's the historical trends? What are the underlying fundamentals? You don't know that unless you subscribe to a data service.
Got it. Interesting. So the information just isn't as widely available.
Exactly.
So when you start digging into a certain stock, do you take more of a top-down approach where you're kind of like looking at the macro environment and then kind of drilling down to the company level? Or do you go from the bottom up and you see something moving on the company level and then figure out what's driving it? Which direction do you go to when you're, starting off like to doing a research project?
I think it's a little bit of both, but big picture, most often it's more top down. It's more saying, what's the global economy looking like and what are the drivers of each individual segment? Shipping's not a monolith. It's actually 6 or 7 different subsegments.
Sure.
There's completely different fundamentals for crude oil tankers than there are for dry bulk vessels, than there are for container ships. So, we have to understand the supply and demand of each segment. But sometimes we do a little bottom up. We'll see a stock that has unusual volumes or is up 200% or down 50%, and we'll say, what's going on there? Or we might see a stock that's trading at a huge discount to its net asset value, and we say, okay, this stock is interesting. The management team checks out. Let's look a little bit more at the macro at the top. So it goes both directions.
Got it. So a lot of your picks, when you're talking about value investments, obviously you're looking at like a bull thesis for many of these stocks, but a lot of traders like to trade both sides of the coin, like to go short. Do you do that? And what would it take for you to see or to at least, I guess, preach more of a bearish thesis on any of these stocks that you do research on?
Yeah, no, it's definitely a good question. And we do a bit of pair trading ourselves, which is where you find 2 stocks that are very similar, like 2 dry bulk stocks, for instance, or 2 tanker stocks or container stocks. And you go long one of them, the cheaper one, the better positioned one, and you short the one that's more overvalued or has a sketchier management team or is likely to have like convertible debt outstanding or something sketchy.
Right.
So we do actually a lot of pair trading. I don't talk about my shorts publicly as much. First of all, look, I used to write, I used to be more like a 60-40, 70-30, where I'd be 60 bullish, 40 bearish or something. But honestly, like the vitriol and the public articles and the shorts, it just wasn't worth it. Like, I'm just going to short this thing. I ain't going to warn you about it. And we're going to do good on our own. So I honestly, I hate to say it like that. I hate to be so cynical, but sometimes this is not worth it to publish bearish research. I do it privately on our service. Like, yeah, we'll be bullish and bearish on our service, but publicly, yeah, I did like J Mintzmyer, like that dude's a 95% perma bull, but not really. Like I've been short several shipping names this year. I don't really like forecast it. You just get on a bullhorn and
yeah, you don't want to be an activist investor essentially.
Yeah. And I mean, look, no, it's just not worth the pain.
I got it. So how would you position yourself for a potential downturn in the shipping sector? Obviously, it's been on a tear this year so far, but what would you do? I mean, would you sit on the sidelines? Would you go short? I mean, how would you position yourself for a macro move like that?
Yeah, again, solid question. You think of these things as cycles, and sometimes I like to turn it into almost like a baseball game, and you talk about innings, right? And so like the first inning would be like bottom of the market, it's time to start buying it, and 9th inning would be like we're super toppy and about to collapse, right? So I like to think of things in terms of innings, and
sure.
As we get to the 4th, 5th inning, we start taking money off the table. We start dialing back our risk a little bit as we get to that, and you never know the innings until hindsight, but you have an idea, right? You don't know if it's the 4th or the 7th, but there's a difference between like the 1st and the 8th, right? Like, you get an idea of like where you're at based on historicals and stuff. And as you get closer to the 7th, 8th, 9th inning, that's when you start going into more pair trades. You take more cash off the table. You have a few more shorts. And so that's something, and you asked earlier, I didn't mean to like not answer the question. You asked what it would take for me to turn bearish on shipping.
Right.
And it takes shipping returning to a respectable multiple across the board. It takes retail investors clamoring into the stocks and bidding them up to record highs. We haven't seen shipping stocks trade at very high multiples since 2014, 2015.
Right.
So that's why I've been, not only because I'm like conscious of publishing bearish research, but that's one of the reasons I've been so perma bull since 2016, 2017, because that was the right side of the table to be on.
I see. That makes sense. So let's take a little dive into your actual process, because I feel like our audience is primarily consisting of swing traders and day traders that I think could really benefit just from understanding exactly how we break down the analysis of these companies that you're doing research on. Whether you're a bear or a bull, understanding how to create a valuation can create a thesis that ultimately you could trade on. So talk about some of the key metrics that you're looking for, like when you're breaking down one of these companies that you're going to research.
Yeah, the number one metric, it's not the end all be all, but the number one metric I look at is price to NAV. NAV is net asset value. So that is like the value of all the vessels, all the ships, minus the debts. You divide it by the stock count and you get what's called an NAV. And that's kind of like price to book. I think people are probably more familiar with that metric, but book value is an accounting value, which is what the company paid for the ship. But I don't care what they paid for it. I care what it's worth today.
Right.
And that's why we subscribe to those data services that provide us literally real time, day to day valuations of what the fleet goes for. And those are real market values on the secondary market. And so we can look at that and we can say, where did this equity trade in relation to the underlying assets? And so you can have instances where I'm literally buying $1 worth of assets for 75 cents. And so even right there, you're getting a margin of safety, because even if you're wrong and it goes down a little bit, you bought the things at a discount.
Right.
That's one metric. There's more, but that's the big one.
That's the big one. Okay. Yeah. Good to know. When you are looking at this particular metric, talk about some red flags. Like when you're looking at a company's balance sheet, one of these shipping stocks, what is it that you're looking for in the balance sheet that would jump out at you, either with a bullish or bearish case?
Yeah, absolutely. So yeah, you cannot just go, I'm so glad you asked that, because you cannot just go off price to NAV. Right. You also have to look at the management team. You also have to look at the balance sheet. You have to look at where you are in a cycle, and 4 or 5 other things. So let's talk about balance sheets, since you brought that up. The first thing I would look at right off the bat is the liquidity. And I'm talking about cash liquidity on the balance sheet. And then I would look at, what is the current cash flow situation? Is this a market where the company is generating more and more money, or is this a market where they're burning money?
Right.
And if they're low on liquidity and they're burning money, then I might not even want to buy, even if it's a big discount to NAV. Right. So that's again, it's simple, but that would be a starting point.
Do you find that when you're looking at these stocks, I mean, I know this is the case with many other sectors, do you find that you're like purposefully being confused by management, the way that they, put out their balance sheets and how they put their numbers in? Are they constantly throwing curveballs to try to make it more difficult or hide, poor management?
I think there's a lot less of that than there used to be. Okay. Shipping in the 2000s and the early 2010s. I sound old when I say way back in the 2000s, but
way back in the day.
Yeah, way back 14 years ago. But no, I mean, managements back then were a lot, I would say, sketchier, and the governance was not as strong. But all these balance sheets, at the end of the day, they're all audited. The numbers are fairly clear, but you have to read all the disclosures. You have to read the notes. You can't just look at a balance sheet. You have to you have to open up the annual report. And a lot of these are not US headquartered companies. So if you're investing in US headquartered companies like Apple, you're used to a form called the 10Q or the 10K.
Of course, yeah.
The annual and quarterlies. In shipping, there's no quarterly mandatory filing. There's only an annual recorded filing, and it's called a 20F. And so the 20F can be anywhere from 100 to like 400 pages. And a lot of that's boilerplate. Like, you have to know where to look.
300 pages of footnotes.
Exactly. Well, when I first started investing in shipping, and that's why, like, from experience in a service like ours, you can really save a lot of time, because like when I first started investing in shipping, I would legitimately like read the whole 300-page 20F.
Oh my God.
And it'd be like a weekend. It'd be like a weekend to read the damn thing. But then you realize that the 220 pages out of the 300 are the same year in and year out. They're just boilerplate. They never change. You learn to focus for certain words, subsequent events, related party transactions, convertible, warrants, dilution, going concern. There's certain words that you look for. And I can read a 20F. I mean, not the entire thing, but I can skim a 20F for like the pertinent info, given what I know now in a company that I invest in 15 minutes.
Wow, that's impressive. Yeah. Well, that was going to be my next question. So like, say I give you, a stock that I want you to look at. Talk about your process. What is the first thing that you're going to do to research that stock? Are you going to immediately go to the 20F? Are you going to Google it? Are you going to go to their website? How do you approach your process to figure out exactly whether there's a trade to be had?
Well, first of all, I stay in my lane. So if it's not the 50 or 60 companies that are in maritime shipping or directly related, I'm gonna be like, yo, Zach, cool stock, bro. Like that's nice, but I don't know up from down. Like I mean, I trust you, Zach, so maybe I'll throw some money at it to have fun with you, but I'm not going to give you an advice. So that's step one, is stay in your lane. If you don't know what you're talking about, like, don't act like an expert. If it's an energy stock, I consult my energy expert. If it's like maybe a biotech, I might look for a guy that knows biotech. If it's a real estate, you get the idea. I stay in my lane. well, step two, I mean, since I'm in my lane, I have covered all these companies for 10 years.
Oh,
So
right.
yeah,
Right.
shortcut rule, right?
Yeah, yeah.
But if I hadn't covered the company, I know what you're getting at, Zach. If I hadn't covered it, I look first of all right away for red flags,
Sure.
balance sheet red flags, management red flags, related party transactions, things like that, things that would just rule it off the table. Like
Right.
I found so many red flags that I'm not going to waste the rest of my day or two with the stock. I just scratch it off. I say, hey, Zach, red flags, not for
Right.
me. Once I've done that, then I would look at kind of the big picture, like where is the cycle at? Is this a dry bulk stock? Is it a container stock? Where are we in the first inning, the fifth inning, or the eighth inning? Then you look at all the multiples, the price to NAV, you look at the cash flow projections. Then I reach out to management. And I'm at a stage in the game now where we've been active in the shipping markets for more than 10 years. Most of the shipping managements, not all of them, but I would say 75% of the companies that we cover, I basically have the management. I don't really call them. I use email, but basically on speed dial.
Right.
I can
They
get,
know you.
yeah, I can get to management in a day or two.
Right.
And they've joined us for interviews and podcasts. So I actually reach out to the management team and then talk to them. There's actually one company that we're researching right now. Haven't issued a research report, so I can't say the ticker or anything like that. But I'm actually in the process of meeting the management team next Monday. So that's something we do before we invest.
That's awesome. So all of these skills that you've acquired in the shipping sector and becoming an expert on these 50 or 60 stocks that you're talking about, like, do you feel like you could take any of the research fundamentals that you're using in this sector and applying it somewhere else? Like, do you see any other sectors that can be dissected the same way that you dissect in shipping?
Yeah, absolutely. But it has to fit some of I don't want to say like first principles, it's kind of cheesy, but it has to fit some of those things. It has to be kind of a smaller cap, overlooked. It has to have enough trading liquidity, that sort of thing. So there's a couple segments that I think apply fairly well. One of them is energy.
Mm-hmm.
And we actually work very closely with a guy who does exceptional energy research. He's actually been, I think, to a Traders4ACause event. Michael Boyd, I think you met him.
Yeah, Michael, of course.
Yeah, he would be a great guest to have on in a later episode to talk about energy, because he does basically the same thing I do in shipping, but he does it in energy. Okay. Energy is 10 times bigger than shipping.
I was going to say there's got to be a lot more.
Yeah, I said 10, it's probably like 20 times bigger than shipping. Energy is a good field for that. So I know a lot of folks that are going to listen to this podcast probably have interest in energy. You can do the same type of approach that I do with shipping in energy. Another one is mining, like mining companies, the gold miners and stuff like that, the iron ore and things like that. I don't have any expertise in those. And that's something I've learned over the years. If I don't have any expertise, like it's fun to, we'll sit down and have a beer and gripe and moan about like Tesla stock or Bitcoin or something. But like, I don't have anything of value to really add besides just hanging out and shooting the shit. So like, I'm not going to, publish a blog talking about Tesla stock. I'm going to focus on my lane. And I think traders who are chart focused and technical focused, they can go out and get into all sorts of different stocks. But people who are truly more value oriented, fundamental focused, they need to be more selective on what they do.
I see. So do you bring technicals into your process at all, or are you strictly fundamentals and you won't even open a chart?
Well, me personally, it's like hieroglyphics, it's like interpretive dance, so, me personally, I'm a fundamental guy through and through, but I respect technicals. So, and I have folks that are on my research service who are just members. We have about 500 members there, and who share their own technical analysis, and they do some phenomenal stuff. I mean, I use technicals to inform things like, if I'm trying to build up a position, I use technicals to figure out where the resistance points are at, where the potential breakouts at. If it's a small cap position, really small, and I know where the breakout points are at, I know people are watching those. So I build my position slower because I don't want the thing to break out before I'm done adding, and resistance, where the resistance points are at. So you get close to resistance, you start taking profits. But one thing I'll say about technicals is, my view, cynical, and we'll just, I'm sure this is going to be fodder for subsequent attacks, but they're like self-fulfilling prophecies. Like technicals work because people think they work, and because people think they work, they work. So, it's kind of a self-fulfilling prophecy.
Those are some powerful words. Well, I had JC from All Star Charts on a few weeks ago, and I asked him if fundamentals play anything into the way that he trades, and he just said, he doesn't have any problem with people who study fundamentals. He just thinks that anything fundamental is being displayed in the chart, so he can look at the chart and he can, determine what the guys that are doing the fundamental analysis are thinking by studying the chart. So what do you say to that? I mean, like,
well, first of all, look, if it's working for JC, like, to keep it up. Yeah, like, if it's working for you, don't switch it up, right? I mean, don't seize defeat from the jaws of victory. Just keep running your race. But I think I would just, a little snarky response, but I would argue that JC hasn't spent a lot of time in shipping. If he has that viewpoint. But I would say, circling back to what I said, I don't know, 10 minutes ago or something, when you're in a very large name like Apple or Microsoft or Tesla or something like that, I can buy that argument. Look, I can buy that there's lots of smart people in there. I can buy that the efficient market hypothesis, I'm not really a believer in that, but the bigger the stock gets, the more likely it's to be efficient, right? Sure. And so if JC's talking about Microsoft and Apple, when he says something like that, like, yeah, right on. Like, I can't pick it apart. Now, if he's talking about Danaos Corp, in shipping, DAC, which was a 10-bagger for us, yeah. You go back and look at the chart when we were buying hand over fist, and the chart was ugly.
Right, right.
So yeah, get out of here with that for shipping.
Oh, interesting. Okay, so you're saying, like, the more eyeballs that you have on it, the more people who are actually studying it, the more, technicals can really paint the picture that can result in a good trading decision.
Sure, and I will mention, since I threw out Danaos Corp, DAC, and I'm going to talk my book. I mean, I invest in researching these names, so sure. Nothing here is, we should have said this up front, but nothing I say on here is any sort of investment advice or trading advice. I like the stock,
Right,
classic.
Right.
What's a classic roaring kitty get out of jail free card? Well, I just like the stock. So I like DAC, I like it a lot. But I think now that it's been a 10-bagger for us. We think there's another double at least left on it. But, now that there's more eyeballs on it, yeah, I think if JC looked at DAC today, DAC, he might be correct. It's exhibited there. But it wasn't 6 months ago because, like you said, like we said, there was nobody looking at it.
Right. Makes sense. So let's talk about some of the key differences between the segments of shipping. I mean, you obviously talk about a lot of them: dry bulk, container ships, oil tankers. How are they different from each other?
Well, first of all, I guess the most obvious difference is the cargo. It's completely.
Yeah, that's a difference.
Different. I picked the low-hanging fruit, Zach. I answer the easy questions first. But look, I mean, there's a total difference between the global demand for iron ore and coal,
right,
versus liquefied natural gas. Like, it's two completely different things. It's like the price of corn and soybeans versus iron, right? They're just different markets. And so that's the thing that I think a lot of people they miss. Like, sometimes, quantitative algo funds and stuff will trade shipping up one day and shipping down one day. But, one day the dry bulk market will be getting a lot stronger, and one day the tanker market will be getting a lot weaker, but the algos will move the stocks up and down together as a basket. So that's our opportunity. That's how we create alpha, by trading against that. We can sell the losers into this stupid, like, algo-driven bullish market, and we can buy the winners when it goes down. So that's how we differentiate and create our alpha. I'm giving away the secrets to the trade here, but yeah, the shipping tends to move a little bit as a monolith,
right?
But over time, 3 months, 6 months, maybe a year, there's price discovery, and the winners, the cream rises to the top, right?
So talk about, in each sector of shipping, you've said, I've heard you interviewed about this, there's roughly 6 different areas. Is that accurate?
Yeah, I mean, you can slice it and dice it more, but I'd say, yeah, 6 broad's good. So
are there particular ones out of the 6 that typically do trade more along the same lines, and then a couple outliers? How would you designate the 6?
Yeah, so crude oil tankers and product tankers. So product tankers like diesel, jet fuel, stuff like that, refined products. They call it clean products, but it's still oil
pretty
stuff.
dirty.
It's not really clean,
Yeah.
Jet fuel's not too clean. But anyways, those two trade very closely with energy and oil. So whenever oil's up, the tankers are usually up. Whenever oil's down, the tankers are usually down, which oil prices have, like, nothing to do with tanker fundamentals. So that's where we create alpha. But if people are just looking for correlates, like if people are long tankers and want to hedge it, I would say you can hedge by shorting some oil or some ship energy stuff. Or if they're long energy, they can maybe hedge that. I'd be careful because it's not liquid, but they could hedge it a little bit by maybe putting puts or shorts on shipping. So those are correlates, like, they move together. The container ships are really logistics when you think about it, because it's all retail goods. It's like t-shirts and toasters and microwaves and stuff coming over from Asia. And so that's a completely different completely different market. I mean, that's like
Right.
Walmart, Amazon, Target, people going to the store and buying stuff, Best
Right.
Buy, right?
Right.
And so that's totally different. It has like nothing to do with oil tankers.
Right.
And so those stocks more so correlate with like logistics trades, like, things like UPS and FedEx, the railroads, Union Pacific, stuff like that.
Okay.
Last fall, they, for whatever reason, were not correlating with logistics. They were
Okay.
correlating with shipping because, once again, shipping, if you're not like me, shipping's a monolith. And so, as you know, last year was not a good year for shipping.
Right.
And all these container stocks were just beaten down into the toilet, even though the logistics trade, I'm talking UPS, FedEx, XPO, stocks like that, they were like 2 or 3 baggers on the year. And all these container ship stocks are in the toilet. And I'm like, that's not right. And so, again, top down, right? That's not right. This doesn't make sense. What are the rates doing? What is the order book doing? And that's what led us last September. And it was very public. You probably got annoyed by me. I was tweeting about it so much, but that's what led us last September, October, and you can go to Twitter and verify this, hand over fist. I was buying every container ship stock I could get my hands on. I was long. There was only like one stock I wasn't long. I was buying everything.
Right.
And some of those names, Navios Containers, 11 bagger, Danaos Corp, 10 bagger, Global Ship Lease, 3 bagger. I mean, every stock, it was basically up.
Wow.
Yeah.
Awesome. So you mentioned before that there's no correlation between the price of oil and oil tankers.
Fundamentally, the stocks have correlation daily.
I was just going to say, if the demand for oil is down, then the demand for shipping the oil would be down, would it not?
Well, that's kind of like the general market thinking of it, right? But it's not always. What drives the tankers is the ton mile demand. So not only how much oil you're moving on the water, but how far it's moving on the water.
I see.
And there's a lot of things that can influence the price of oil downward that might be bullish for tankers. Let me give you one example. If OPEC says, all right, the world economy's recovered, we're going to stop doing all these cuts and we're going to actually increase our exports, that would make oil prices crater, right? They drop $10 overnight,
right?
If they came out with such a statement.
Right.
That sort of statement that craters the oil prices would be the most bullish possible thing for oil tankers because there's a flood of oil on the market. But the stocks are so stupid, they probably trade together because there's all these machines and algos and folks that trade those patterns.
Got it.
I shouldn't be saying this, man. It's like when you're playing poker, they have a phrase like, you don't tap the aquarium. If I keep saying this stuff, it might stop working.
Well, everybody knows now that you're the expert. So, as much as analysis that they want to learn to do on their own, they should check out your service if they really want to dig into this stuff. So just this week, we talked about this. Dry bulk rates recently hit 11-year highs. So aside from looking at individual dry bulk stocks to find potential trades, is there a place where traders can kind of look for sympathy plays to this, phenomenon?
I see. Remember that I'm pretty fundamental oriented. So
sure.
I'm, if it's based solely on the dry bulk stuff accelerating, I'm going to be mostly just focused on those dry bulk trades, to be honest. However, there are some correlates, and I think some of the correlates would be miners. Some of the mining companies would be of a little bit more interest, and a lot of those have already moved. But things like Vale, for example, BHP, Rio Tinto, stuff like that, would be interesting sort of sympathy plays because the dry bulk sector is moving up because iron ore prices are moving up and there's a little bit more transport of that sort of thing. So something like Vale would make sense, I suppose. One thing I would note is for traders, whenever something gets a little bit hotter, and dry bulk started to get hot, it creates more opportunity because the daily volumes are up and the volatility of the stocks goes up a little bit. So it creates almost like more of a fun sort of profitable playground for you to come into and trade. Whereas some of these shipping names that I cover are fundamentally great companies. Like I love them, but they're just not great trading stocks. They're boring. They don't really do anything.
Got it.
So I would say more so whenever I'm posting about something, say I love the dry bulk stocks. If you're a trader and you don't really want to own and invest the company, you're just a day trader, or maybe you own for a week or two. Oh, Mintzmyer is talking about dry bulk stocks. Okay, cool. Volumes are probably going to go up. I'm agnostic, long, short. Like if the guy comes in and trading short and he makes money, like, dude, good for you, man. Keep it up. I don't care. I like liquidity. Bring it on.
What constitutes an exciting move to you? I'm just making an inside joke here because yesterday you sent me a stock and you said, "Hey, check this out. Here's a shipping stock that's cratering," and it was down 10%. And I made a joke because to a day trader, they're not looking for a 10% move. They're looking for a 50, 60% move. That ultimate volatility. So is 10% like off the charts when it comes to these shipping stocks and a daily move?
I wouldn't say it's off the charts, but it all depends on what instrument you're using. Look,
Sure.
if you're using at the money or in the money calls or puts, a 10%
Sure.
move can double your money.
Of course.
So, I mean, who are we talking to here? I mean, are we talking to some guy who's putting $500 on, one stock? Yeah, dude, like 10% up.
We're
He's
talking
like,
about degenerate gamblers here.
I can go to, hey, I lived in Vegas for 4 years. I can get down with that. But no, I mean, if you don't want to just pay for a dinner at Red Lobster, yeah, you might want more than 10%. But no, if it's not the daily swing that I care about. Look, I mean, it's if I own a stock for 2 or 3 months, it's the total profit I make in 3 months, and exponential powers come in. So you might say 3 or 4% a day is boring, but 1.04 to the power of 25, and give me the math on that.
Where's the sweet spot for this? Are you suggesting that given the how this industry and this sector is cyclical, that like a swing trading style strategy is what would probably work best, utilizing your research?
I believe so. That's kind of what I do. I am a fundamentalist value guy at heart, but I do I call it cycle trading. And I talked about the baseball analogy. I'm not a classic value buy and hold guy. Like, I'm not coming in here and saying like, buy this company and just like go to sleep and forget about it. Like, no, shipping, that's the wrong industry for you, brother.
What's the longest position that you have right now in your portfolio?
Like longest term that I've had.
Yeah, the longest term hold that you have in your current portfolio.
I don't want to. I'm pretty sure it's let me think about this a little bit. I think it's Dorian LPG. I'd have to pull up my spreadsheet. I have like 27, 28 active positions. So I'd have to pull it up to give you 100% like honest to God answer. Okay. But I'm pretty sure it's Dorian LPG.
And how long have you had it?
I've traded in and out of it, but I've been at least partially long for like 4 years.
Wow.
Yeah,
that's like an eternity.
That's very long for me. But look, I mean, but that doesn't mean that I bought it 4 years ago and I never sold a share.
Sure, of course.
Take
profits.
Yeah, and I at one point it's a triple size position. At one point it's a half size position. But it's such a good value oriented, strong company, good management, good capital allocation, beautiful macro picture that I could not double negative. I could not be long. I had to have something there.
Had to be in it, right?
Yeah, had to be in it.
All right, very interesting. Okay, let's move on to some questions that we got from some of our. We actually went out on Twitter and asked for some questions that people wanted to ask you. So this one is from a gentleman named Ravel. I believe that's how we say his name, Ravel. So he says, Jay is providing deep analysis, which he's a big fan of, but he rarely never mentions or weighs possible detrimental impact of carbon regulations on earnings or NAV of shippers. Will non-eco fleets suffer, or is it not worth to be dramatized? For me, I sense a strong impact on shippers who just reject the start of the transition to eco.
Wow.
What say you?
Thank you, Ravel. That's a really solid question. I think we could probably spend an entire podcast on something like the ESG impacts and carbon stuff on shipping.
Sure.
Long answer short, it's another sort of situation where the first take is the broad consensus is kind of going to be wrong on this, because people are going to say, oh, more regulations are coming to shipping. That's bad. That's going to drive profits down. Right. The reality could not be further from the truth. The more regulations and the more restrictions that you place on shipping, the better and the bigger profits we're going to make. And the reason why is the number one way, a technologically proven way to cut emissions in shipping, is to reduce the speed at which all the vessels travel.
I heard you talking about this with Chris.
The vessel emissions curve is like exponential. The difference between, and it's different for every ship, so don't like quote me in science. I don't have a PhD in this topic, but we're looking at the exponential curve of these shippers, and the difference between like 10 knots and like 13 knots, to use one example. You would think, oh, that's like 20-30%, because that's the speed difference. The emissions difference is more than like double.
Very
so
interesting.
If every single shipping asset in the world had a speed limit of 10 or 11 knots, we would reduce emissions from shipping overnight by somewhere in the range of like 30 to like 40%. I mean, it would do wonders. It would be the easiest thing to do for global warming you could possibly think of. However, think of what happens to the supply and demand if you force every single ship in the world to travel that much slower. I mean, you would have astronomical shipping rates like that you could not believe. So that's just one example
So
of like,
drive up the prices of everything essentially.
exactly. So that's part one. That's one thing. That's one thing. There's a lot more to look at. So one more thing, and I could list like 10, but one more thing to look at is the more and more regulations you have on these emitters, on these high polluting vessels, the less and less competitive they're going to be in the market. And the more and more competitive the modern tonnage with eco design is going to be. And most of the companies that we're invested in have heavy proportions of eco-design modern tonnage. So not only are rates going to go up because vessels are slowing down, the old crusty, rusty stuff is going to get squeezed out of the market, and we're going to make even bigger profits with our modern tonnage. Those are two things. We could probably list 10 if we kept going.
Do you think that these price hikes are going to be passed right along to the consumer? Do you think our consumer goods are going to continue to go up?
You know, I think for the most part, yes. And I think it's the same way for energy. I think at the end of the day, like utility bills are going to go up. Gasoline prices are going to go up. That's part of it. If we really care about global warming, if we're being true to ourselves and we actually prioritize this, we have to pay the bill. It's not free money. Like I think costs are going to go up, and that's the tax of living in a clean, environmentally conscious society, and it's a tax I'm willing to pay, and I think every person should be willing to pay that tax. I will say one thing to Ravel, and maybe it's the fault of Twitter. You know, Twitter has character limits, and I don't publish full reports on there, but we pay very close attention to the regulations. We're paying very close attention to this stuff, and so it's not something we just wish-wash.
Of course, you're foolish not to, right?
Absolutely. Yeah, Ravel said that, right? He said that the companies that don't pay attention are going to lose, and he's correct.
Right.
Yeah.
Makes sense. All right, next question is from Arturo. Why would the average institutional investor get on board the shipping sector when it's so volatile and cyclical? Is the long-term compelling demand story the most decisive factor? Low order book also seems a good one, but it can change dramatically in just 15 months.
Yeah, Arturo is asking a great question, because we don't have a lot of long-term buy-only, long-only type funds, institutional funds in shipping. In fact, most of the institutions we have in shipping are either boutique hedge funds, or they're family offices, or they're more so like private equity, where they like invested in like a 5 or 6 or 7 year time horizon. They wanted to buy some new ships, and private equity came in and footed the bill. Private equity has a terrible track record in shipping. They've lost money on almost all their investments. So yeah, there's not a lot of institutions in shipping, and we would love to see that change. So I'm glad Arturo is thinking about that. That's like the next level. That's how do we get shipping back to a realistic, reasonable multiple? And the number one argument I would make if I was selling this to institutions is a lot of these are non-correlated, keyword, non-correlated alternative assets, right? These are assets that the actual results of the company don't necessarily depend on the S&P 500 or the NASDAQ or the Russell. These are alternatives. It's like buying timberland or something like that. And so, but that's a legitimate, like you laugh, but timberland is actually a legitimate allocation. Like I studied for the CFA, and there's actually an entire chapter on forestry and timberland. Talk about niche, right? Like timberland makes shipping look like it's like it's diapers. It's legit. And that's something I think insurance companies with big floats, companies like Prudential and Allstate and Berkshire and stuff like that, I think they're foolish to not have 1 or 2 or 3% in shipping.
Okay. The next question, these are going to be quicker ones. Brian asks, can you discuss the dynamics of Zim's asset light model versus other container companies that are asset heavy? How booming rates and rising asset prices affect each differently?
Oh, another good question. I think probably some framing, because I think this is more a generalist podcast. People are like, what the hell is Zim? Zim Integrated was a company that came public at the end of January, and they came public in the worst possible time, and they came public the week of the GameStop fiasco.
Sure, of course.
And that caused their IPO. First of all, nobody was paying attention to it because everyone was like, on Wall Street bets, making snarky comments and up and down voting. But no, first of all, nobody's paying attention to it. Second of all, there were some people in the market, myself included, who were legitimately concerned that thing could spiral out of control. And so a lot of people pulled out of the offering, and the initial public, it was a flop. It's one of the worst marketed and poorly performing IPOs I'd ever seen. Right. It was supposed to be 16 to 19. Was the pricing range.
Right.
And normally in an IPO, when it's 16 to 19, it means it prices at 19 or 20, it trades at 25. Right? That's like a normal IPO.
Right.
Well, this thing was marketed 16 to 19, priced at 15, dropped to 11.50 the first day.
Ouch.
Oh my goodness. I was looking at this thing. I'd been reading the filings, and everything I read about the company was too good to be true. I had to call up some trusted, like basically associates and friends and stuff, and say, "Hey, take a look at this for me. Am I cross-eyed? Do I need to get something? This is too good to be true. Like this thing trades at like 1 times forward earnings.
Right.
What the hell is going on here?"
Right.
And so I couldn't believe it. And so I spent a week or two just sanity checking myself. And then we bought the thing hand over fist between 11 and 14, hand over fist. And we're recording on Friday, 23rd. I don't have the price chart in front of me, but I think it's like $31. So we basically almost tripled 2.5 times our money in 2 or 3 months. So that's a background to folks. That's why Artur was asking about Zim, because otherwise, like, who cares about Zim? Zim is asset light, which means they charter in all their ships. They don't own the ships.
Okay.
And when they IPO'd, people were using this as like a negative. Oh, they don't own any ships. Okay, so what? Like they have the ships chartered. They have the control of the market, and asset light means that they charter the ships in for 1 year, 2 years, or 3 years. So they say, I want to take a shipping lane from, let's say, China to the West Coast of the United States. I need 4 ships for that. I'm going to go lease those ships. I'm going to go rent them for 3 years. And if I don't like the market in 3 years, I give the ship back. Right. I think the asset light is the way to go. I'm like, I view it the other way around. Like, why the hell not be asset light? So that's the advantage to it.
Who are they leasing them from?
You scale it up. They're leasing them from, I'm biased. They're leasing them from the companies I own, which, I tell you, man, I eat my own cooking, but I talk my book, and I'm long Zim, very long Zim. I really like the stock, but they're leasing ships from Danaos Corp. They're leasing ships from Global Ship Lease, from Navios Partners. They're leasing ships from all the companies I own, but it's 2 different types of plays. One play is like industrial. I'm going to own an asset. I'm going to lease it out. The other play is like a service provider. Mm-hmm. So think of like UPS and FedEx. Like those are like the people who are doing the shipping, but underneath there's companies and banks and institutions that actually own and lease those aircraft.
Sure.
Right? Yeah.
Absolutely. Makes sense.
So that was a long answer to a short question, so I apologize, but
no worries. I think this is a good question to end it on. Bevan asks, what are your current top 3 recommendations in the dry bulk sector?
Ooh. All right, yeah, he cuts to he's getting all
cuts to the core.
Cuts right to the core. Start with this one. In the comment section, someone could put like a timestamp, like J Mintzmyer said something useful at timestamp 42:35. Like, thanks, Dick. But
well, you could say just subscribe to my service, then maybe you'll know my top 3 picks.
Yeah, right? That's kind of the douchey way around it, So maybe we won't do top 3 because that is kind of unfair, I think, to my subscribers. But I'm not going to just be, subscribe to my service. Look, I'll tell you some of the stuff that I'm already bought. I've already bought it. I'm already long it. That way my subscribers already had, they had the chance to buy and get in there. So one of them that we've been long in the past is a safer, more risk reward play. There's a lot less downside if the market crashes. Right. That also means there's a lot less upside if the market goes up, but it's more for the more conservative guy.
Less volatile.
Exactly. And that's Genco Shipping, GNK. And I'm long the stock. I actually just took some profits on it. I bought it in 9s. I just sold some at 13.50. So I might sell some more in the future. Like, I'm talking my book here, guys, but that's a risk reward play. Okay. Now I'll give you one that's a little bit more, let's say, volatile.
A little edgy.
A little edgy. Safe Bulkers, stock symbol SB. That little guy has some leverage. When a market's going up, you want leverage to like your eyeballs, right? You want the most debt possible, but you also want a management team that's trustworthy.
Sure.
And Safe Bulkers has both of it. They have a huge leverage, but they have very strong cash liquidity. So the leverage is not dangerous. It's the perfect type of leverage. It's like having a 30-year mortgage on a house. You have a lot of leverage, but there's no fear. There's no concern. And the management team is trustworthy. I've watched these guys for 13 years now, 14 years, and they've always been fair. They've always been good actors. They've always paid big dividends when they can afford them. This company is like, it's like 80% leverage right now. So it's kind of like buying, it's almost like buying Danaos Corp last fall. When I bought Danaos Corp last fall, I was buying that thing for $5. And it's like, again, I don't have the chart in front of me. It's like $51 today or something. You can pull it up if you want and give people an updated quote. Safe Bulkers was like $1.50 or something like that. And that would be its $1.50 equivalent to Danaos at 5. Safe Bulkers now is a little bit over $2.50. If dry bulk is the real thing, Like if this thing comes true, we don't know yet. We think it will, but we never know until it happens, right? But if dry bulk is like the real deal, safe bulker could triple, quadruple. I mean, it's a slammer. We love it. So that's, I would say Genco on the risk reward, and safe bulkers is kind of like the exciting, volatile play.
As exciting as we can be in the shipping sector.
Well,
right?
dude, if you don't think a 3 or 4 bagger is exciting, like, man.
Check your head, right?
Yeah, check your head, check yourself.
Cool, Jay. Well, I want to thank you for being on today, and I want to give you a chance to plug your service. You gave me some unaudited results of Value Investor's Edge and how well you guys have done over the years. Annualized, I'm looking at 38.8% return over since your inception. So take a second and kind of plug what you guys do and why people would be wise to make an investment in learning.
Yeah, look, Zach, and I always put a disclosure in those too. Like, it's unaudited, it's presented from our model portfolios. You can track them, you can see all the same performance, but it's not audited. It's not a solicitation. This is not an investment product. I do not manage people's money. I do not provide direct investment advice. I'm not going to tell you should put 10% of your portfolio in XYZ stock.
Sure.
Right. What we do is we are a research platform. We provide what I believe, I'm biased, I'm selling the product, but I believe we provide the world's best shipping intelligence platform for investors. Okay. I don't think there's anything out there better than what we provide.
Okay.
And I stand by that. And so if people really want to get into this market and they want to trade, you can invest, you can trade, you can do anything you want. But if you're going to be involved in one of these symbols, I think you have to be on our platform. You have to be engaged. We have an active chat room where we have about 500 members, and we have 100 plus that are very active in our chat room, and they're always posting the latest news. They're posting the latest trends. They're getting in discussions about what stocks look better and what some of the risk factors are. So think about like leveraging your potential, right? You're not just doing stuff on your own. You got, 500 other members that are also sharing ideas. You can use our analytics platform. You can cut you still have to do all your own due diligence, but it might take you a week to figure one of these names out. You can read our reports and figure it out in an hour or two.
That's terrific. Well, I can't think of a better pitch for it than that. I mean, nobody likes doing research except for you. So,
yeah, it's true. No one wants to geek out as much as I do. But hey, it's lucrative, right? And if it wasn't making money, if it wasn't a good thing for us, like we'd be in mining or we'd be in energy, right?
Of course, makes sense. Well, Jay, thanks for being on the Traders4ACause podcast. I appreciate everything that you do and for your support of Traders4ACause over the years. And hopefully we make it back to Vegas. Whether it's going to be this year or not is still up in the air, but we always appreciate your support and being a part of the organization. So
absolutely, Zach. It's such a great thing. And I wish more folks, I think you have a pretty good penetration, so to speak, in the trader world.
Yeah.
But I think in the investor world, there's not quite as many folks who have gotten on board with kind of Traders4ACause and what you guys do. And I hope that changes going forward, because what you guys do is so cool. Like, you're combining kind of that networking with like education, right? Helping folks learn more. Yeah. And the most important thing of the charitable giving and giving back. And I just hope to see the community continue to grow. And fingers crossed for Las Vegas, October 2021, fingers crossed, but obviously we got to watch the COVID trends and whatnot.
Absolutely. Jay's on Team Vegas, if you couldn't tell. Chomping at the bit to get back there, obviously.
Oh, I miss it. Boston's fun. Boston's great and all, but like I've been to Encore Boston Harbor now, and it's just not Vegas. No.
Are you a Vegas townie? Is that where you're originally from, born and raised?
I'm from Southwest Arizona, so okay. Regionally, yes, but I'm not really a big Vegas person before I moved there. But I just like it. I like everything about Vegas. The people there are great. They're hardworking folks. The tax regime in Vegas is very good. There's some of the best restaurants and entertainment in the world. There's so many things to like about Las Vegas. The only thing I don't like about it is the summers. The summers are unbearable. Yeah.
Well, you say Southwest Arizona, that's like Yuma, right?
Oh, it's worse. Yes, it's worse than in Vegas. But that's why I got the hell out of there.
So you were born in Yuma?
I was actually born in Anchorage, Alaska. So, yeah.
Just gets more and more complicated.
We're going to
so many layers of the onion here.
So many layers. But I went to high school, and most of my friends and stuff are from Southwest Arizona. Like, that's my hometown. My hometown is Dateland, Arizona. That's what I call my hometown.
You are from Dateland? You're kidding me.
You know about Dateland?
Absolutely, because I've driven from San Diego to Tucson on several occasions. So I've stopped in Dateland. I've gotten a shake. I've bought them
You single-handedly
I
stimulated
didn't
the
think that
local
anybody
economy.
actually lived there. Are you serious?
I am from Dateland, Arizona.
There is a population to Dateland?
I went to the K through 8 school, Dateland Elementary School, and we had 220 students K through 8 when I was there. Yeah.
No kidding.
We had a post office. We had one grocery store. The grocery store shut down, unfortunately. We have a gas station.
So does everybody shop at the Dateland mini mart now? Like, you know, the truck stop? Is that where everybody gets their groceries?
If you want something more than a gallon of milk or a loaf of bread, you got to travel 30 something miles, man. It's
my
crazy.
God.
Yeah.
That's brutal.
I went 30. I drove 30. Well, I took the bus, but eventually I drove 35 miles each way to high school.
Jay, I think we're sitting on a gold mine here if we find an Instacart for Dateland.
Oh man. Well, there's only like 1,200, customers. So
1,200. Well,
Yeah.
It's a niche market, right?
Very niche. Very niche.
All right, Jay. Well, thank you again for being with me. And in the meantime, trade profit, make a difference, everybody. And we'll see you next week. Take care.
Thanks, Zach.
Oh, God. You could be the first plumbing foreman to be working on a PhD at Harvard.
Oh, wow.
So how am I introducing you? J Mintzmeat, self-proclaimed shipping expert.
I use my shipping profits to get the big blue seat or whatever it's called. What is that? Lobsters, they have little eyes. I'm like the only guy that lost money in 2020.